turn now to Nuveen's Tony Rodriguez, expecting recent rate volatility to persist throughout the year as investors, quote, react to growth numbers, virus developments and central bank actions or expectations. Tony joins us now for more. Tony, I think we should begin with what you anticipate just in terms of the sequencing for 21, for 22, for 23, for Chairman Powell's Fed.
Sure. Good morning, Jonathan. Good to be with you. And our view is that the Fed, if you had to look at it in these annual increments, 21 is the year of patience for the Fed. 22, that's when we think they will finally start to raise short-term rates. But we don't foresee anything in 22, which is where you're actually starting to see Eurodollar futures price in. So the market's pricing a more aggressive Fed than we believe will take place. But we think they will be more aggressive than what their current summary of economic projections are telling you about the first rate hike.
So, Tony,
which is over 2 percentage points into the 6.5 type of range. We think you'll see a decline in the unemployment rate by about 0.5%, maybe 0.6, and only a very marginal 0.1% increase in their inflation forecast. But we do think that the dot plots, as Mike was just talking about, for shifting the median, but we do think you'll get at least 2 or 3 and potentially a full 4. So we do think that the first rate hike is going to be pulled forward by the data coming out of the Fed.
Let's think about what this means for markets. Real yields have been on the move. And, Tony, I know you expect to move from negative 60, 70 basis points on a real yield somewhere closer to zero. Can you give me a time frame for where you're expecting that move to develop and how quickly? And then help me understand how the broader fixed income universe has to reprice off the back of that move.
Sure. So the move that we've seen so far this year has been more rapid than we'd expected. We thought we'd probably hit these type of levels of 1.5% closer to mid-year, and we think that we'll finish the year closer to 2%, between 1.90, 2%, but basically a high one-handle 10-year rate. We think that real yields will basically increase alongside those nominal increases over the balance of the year, getting closer to, as you mentioned, that 0% level. And in the context of the broader fixed income market, and it's part of the kind of growth story, so financial conditions remain relatively well behaved.
Right.
We think that is very supportive for spread sectors in the fixed income market.
Tony, that final point is the crucial point. That's what really shapes the capital allocation of you and the team over at Nuveen. So most people would come on this program and say credit is priced for perfection. You think it's priced for reality. Why that distinction?
And the distinction is because we see fundamentals improving pretty significantly. So when you look at, for example, say the deeper parts of the credit market like high yield leveraged loans, we think to not at levels that we saw back in the last 2 or 3 recessions. So companies borrowed a lot last year, but they kept a lot of cash on the balance sheet as well, given all the uncertainty around the pandemic. As we move through 2021 here, we're expecting as much as 20% EBITDA growth. So the interest coverage is very, comfortable for the high yield market. The leverage numbers are going to come down. Price to that reality of very solid fundamentals in 21 from our perspective.
Priced for reality, not for perfection. The view of Tony Rodriguez and Nuveen. Tony, it's great to catch up, sir. Always good to see you. Thank you. Tony Rodriguez there. Coming up, the analyst.